want to approach the fundamental precept or the fundamental concept from a different angle. It's so important to understand this. Nobody talks about it. It is in nobody's interest to talk about this, so it doesn't get talked about. So I'm going to try to come at this from a different angle because it's so easy to understand, but at the same time, it can get confusing. So let's get into it. Now before we do, I'm going to minimize my face. Okay, so here we go. The fundamental precept. As I've said many times, investing is a positive sum game. We can all have more than our original investment. If you look at any long-term chart of any developed market, it is an upward sloping line. The market gets more valuable as time goes by. There are fundamental reasons for this. We get better at what we do over time and generations, and companies are continually reinvesting a portion of profit. Investing is a positive sum game. However, investing is a zero-sum game around the market return. So again, if you look at any long-term chart, it has a positive market return over the long term. Investing is a zero-sum game around that number. Now here's a conceptual aid as to why. So here we go. Here's the setup. Let's say in our economy, every investor in the market has to invest through one of three asset managers. So these three asset managers manage all money in the market. We'll call it the Canadian market, and for simplicity, we'll say the TSX 60 is the Canadian market. There's no other companies other than these 60 in Canada. So what does this mean? This means that every share outstanding of each of the 60 companies is owned by at least two of the three asset managers. They are probably owned by all three, but at least two of the three asset managers. One active asset manager might decide to underweight a company completely and hold none of those shares. But all shares of every single one of the 60 companies is owned by at least two of the three and probably all of the three. So then another assumption that we're going to make here is at the start, each asset manager manages 1/3 of all money invested. So we have three asset managers. One is passive and the other two are active. And we're going to say that the total market value of the 60 companies combined is $2 trillion at the start of year one. This isn't too far from reality. The TSX 60 right now has a combined market capitalization or a market value of slightly under $2 trillion. Okay, so year one, the assumption is the market rises 7% and active manager 1 gets 10%. So if the market rises 7%, the total market value of the 60 companies, of the market of the 60 companies, grows to 2.14 trillion. Now this is important. The gain is finite. The gain has grown from $2 trillion to $2.14 trillion. Now we know the passive manager grows their portfolio by 7% just by definition. And we're also stating that active manager 1 grows their portfolio by 10% to 0.733 trillion. Okay, so we have 2.4 trillion of market value. Passive manager captured their share. Active manager 1 captured their share. Well, by simple arithmetic, we know what active manager 2 has captured. Their portfolio at the end of year one must be 0.6934 trillion. Okay, so 2.14 trillion minus 0.7133 trillion, that's 7% growth of the passive manager's portfolio, minus 7.333 trillion, that's 10% growth of active manager one's portfolio, leaves us with, it's just simple subtraction, 2.14 minus 0.7133 minus 0.733 equals 6.934. Now from that we calculate that active 2 manager grew their portfolio by 4%. The dollar gain of active manager 1 is completely offset by the dollar underperformance around the market return of active manager 2. Now it's simple. The reason it's conceptually understandable with 2 active managers is if one active manager wants to overweight the shares of a company or some companies in the market, they have to get active manager 2 to underweight the same company. So every overweight position is offset by an underweight position at the other active manager. Now at the end of the year, these decisions, let's call them bets, these bets have either paid off for one, and if they didn't pay off for one, that means they paid off for the other. Okay, so now we're going to do a 5-year number. So we did 1 year. We saw what happens when the market rises by 7% in year 1. So now we're going to look at year 2 to year 6. So this is a 5-year period after year 1. And here's the assumption. The market still rises at 7%. And active manager 1 gets 5%. So this is the value. This is the value that the market will grow to. 2.14 times 7% to the power of 5 for 5 years. 2.14 times 7% to the power of 5 grows the market to 3.001 trillion. So we started at 2 trillion, and after year 6, by the end of year 6, it's 3 trillion. Passive manager 1 grows their portfolio to 1.004 trillion. This is the end of year 1 performance times 1.07 to the power of 5. Active manager, we're stating this, grows their portfolio by 5.5% per year. That takes their portfolio by the end of year 6 to 0.9584 trillion. By the rules of simple arithmetic, active manager 2 has to grow their portfolio by 1.0387 trillion, and that equates to an average annual return over the last 5 years of 8.42%. Again, the gain is finite. There's only $3 trillion to be shared among these active managers. We know what portion of the $3 trillion the passive manager gets. We state what the active manager 1 gets. 5.5, that grows their portfolio to 0.9584, and we can calculate what active manager 2 gets. So another way of looking at this is active manager 1 and 2 combined captured 0.5703 trillion. The balance, the passive manager captured 0.2907 of the growth. The growth is 3.001 minus 2.14. The passive manager captured 0.2907. The combined active managers must capture the balance, and the balance is 0.5703. Now, so it is pretty simple, it's pretty intuitive to understand that if one active manager outperforms the other active manager, well, that growth of the outperforming active manager comes at the expense of the other active manager. It has to. The gain is finite. So another way of saying this is we know by definition that the passive manager earns the market return. The performance of the active manager's portfolios. So you combine the portfolios, you see what the value was at the start of the 5-year period, what the value is at the end of the 5-year period of these two portfolios added together, and these two portfolios added together must have grown by the market return, 7% in this example. So, this is proof that the market grows, the passive manager gets the market return. The remaining active managers, as a group, as one portfolio, must get the market return. Some will outperform, that's completely offset by others that underperform, and vice versa. Some will underperform, that's completely offset by others who will outperform. So I'm going to sum up. Here's the sum up. Market gains or losses are finite. The combined portfolios of the three asset managers must grow by the market return before cost. The passive manager, by definition, earns the market return, so we factor them out. The remaining active managers, the remaining two active managers in this example, if their portfolio is combined, it must grow by 7%. If one of the managers gets above 7%, the other one must underperform to get the combined portfolio average to 7%. Now, I touched on this, but look, any divergence from the market return by one manager necessitates an offsetting divergence in the opposite direction from the other active manager. In other words, every share outstanding is owned by at least two of the three asset managers. The passive manager has a market weight position in all 60 companies. Now, the active managers, if one active manager wants to over or underweight the shares of a company, they must trade with the other active manager. There's no getting around that. So at the end of the year or at the end of the period being measured, if one active manager wants to overweight a company, by necessity, the other active manager must want to underweight the same company. So one of them is right at the end of the period. They've both made bets. One bet is right and the other bet is wrong, and the two offset each other. Any outperformance of one active manager is offset by underperformance of the other. This holds true if we remove the three asset manager limit. Forget about three. Call it 1 million asset managers. There's 1 million asset managers out there. The passive managers get the market return. The remaining active managers their portfolios, when combined, must equal the market return, and any outperformance is offset by underperformance by other active managers. You walk into a room of active managers and you say, which of you active managers will outperform your benchmark? And every single hand will go up. They will all say yes, next year or next period or whatever period in the future you have in mind, I will outperform the benchmark in that period. It makes sense. If they didn't believe that, they shouldn't be managing the money. However, we know that all can't outperform. As a group, they must average the market return. So I've got a spreadsheet here. Let's see if this adds any value. So it's somewhat simple math, and I've introduced a fee here. Okay, so at the end of year one, here's the portfolios. The passive manager has 0.7133 trillion. The active manager 1 has 0.733 trillion. Active manager 2, the balance. The total portfolio, or the total market capitalization, is 2.14 trillion. Now we say, okay, passive manager gets the market return of 7. Active manager underperforms. And this is stated. If active manager 1 underperforms by this magnitude, active manager 2 has to outperform by this magnitude. So you can see the growth. Now, just want to show you this. So here, we got some pretty high fees here. 15 basis points for the passive manager and 2% for the active managers. What does this mean over a 5-year period? The portfolio grows to $2.8108 trillion. If the fee was 0, it would have grown to 3.0020. Now, here's how the fee breaks down. 3.0020 less the fee, that's just the addition of all these fees, less the fees not compounding in the account, comes to 2.81 trillion. Now, you think of it this way. Here is the market capitalization value of the Canadian market at the end of year one to show you the effective fee, here's the portfolio at the end of year one, growing at an average annual rate of return of 7%, and with no fees, would grow to $16.29 trillion in 30 years. So that would be at the end of year 31. With the fee structure that we have here, which is pretty high, but it's interesting to look at the effect of fees. After 30 years, it is significantly lower than the fee-free portfolio. So again, I want to make sure that this is understood. So whether we look at, let's look at the fee-free portfolio. The passive manager gets 7%. This combination of portfolio, 0.733 trillion, 0.6934 trillion, if combined, must grow by 7%. So this grows by 7%, and this combined portfolio of both active managers grows by 7%. One active manager outperforms, that necessitates that the other active manager underperforms. So it seems so simple, but nobody talks about this. It's not in anyone's interest for you to understand this. It seems, when you look at low-cost, passively managed investing, it seems like a no-brainer when you view it this way. Many people know this, but it's not in their interest. Even the Vanguards and the BlackRocks of the world, big passively managed managers, they also manage active. And they also have some high fee products. And they don't really want everybody rushing into their lowest fee product. But it is hard to argue that for every investor out there, that the low cost, passively managed option isn't the best option for them. And the lower the cost, the better. I talk about Vanguard and BlackRock all the time because they have some product that is brutally low cost. That means you get to keep more of that market return. And you take no risk of underperforming the market return, except by the amount of the fee, and the fee is low. You can build, I've said this so many times, you can build a low cost, well-diversified portfolio, completely diversified portfolio for under 10, 11, or 12 basis points. That is at least 15 times less expensive than what you get if you go through a financial advisor. But you have to do this on your own. There is no way that anyone can generate enough revenue to be a financial advisor to you and offer you these products. So I'm going to leave it there. The arithmetic, all you need are the immutable laws of simple arithmetic to prove that over any time period, passively managed investments outperform actively managed investments as long as the cost to passive management is less than the cost to active management. Okay, thank you for watching.